from a founder last Tuesday night. Pipeline's empty, board meetings Friday. Should I raise around? Yeah.
Well, good morning. You heard a little bit of our weekly wisdom music this week. If you want to hear more about that and you are on LinkedIn, just go down to our post on Sunday to see that. Or apparently, one of our listeners is going to put that in a Spotify list soon. And you will also hear some of our weekly wisdom music in some upcoming conferences because we've had several DJs reach out to us and ask us if they could do that. So, I'm not a music producer, but I don't know, that might be my retirement gig is producing music. But we're not here to talk about music today. We're here to talk with Sarah. Our topic, as it always is we not only want to tell you what to do, but more importantly, we want to tell you what not to do. And today's topic is seriously don't raise venture capital until you know your real options. Those of you that have joined before know I'm Dan Griffith. I have about 15 years helping B2B SaaS and service firms accelerate their revenue growth. I'm an expert in go-to-market strategy, sales process design, and fractional leadership. I have three key roles: founder and principal consultant at Greater Gain Group, co-founder of revenue strategist at Grow Digital, and I'm a speaker, author, and podcast host. I am also available for keynote talks, panel discussions, and podcast guest appearances. And today, we've got Sarah Willett joining us. Sarah is a senior advisor and board member with more than 35 years of experience. I know she doesn't look that old. She started when she was 3. So she has 35 years of experience in corporate and investment banking, specializing in healthcare clients. So again, today is going to be very, very healthcare focused. And her career has been dedicated to advising businesses on capital raising strategies, transformation, and risk mitigation. So Sarah, welcome. Thank you for joining us today.
Thank you, Dan. It's a pleasure to be here. Appreciate you having me. Looking forward to our chat.
Yes, and so we're going to, as usual, dive right in. We've got a lot of questions for Sarah today, and hopefully the discussion is going to be great. We will be monitoring the comments if you have comments or questions, but in all likelihood, we'll have to answer those afterwards because we have a full slate today. So Sarah, you've worked with countless healthcare companies over 35 years. What's the biggest mistake you see founders make when they need to start raising capital?
Yeah, Dan, that's a great question. And what I would say is, I think it is not choosing the right investors. And most founders are extremely busy, and it's understandable that they could gravitate to the first investor who comes along and wants to put money to work in their business. However, not partnering with the right investor can create friction when there is misaligned expectations or could even block future fundraising routes. So in my experience, a better approach is when founders carefully select their investors and target those that align with the stage of their company, their industry, plus their vision and their goals. So it's important to consider the value of smart money and investors who can bring expertise, a network to help you grow, and perhaps relevant operating experience. So my suggestion for founders is to do your research on potential investors, take the time to do that, and make sure that you are aligning with somebody who can work with a company at your stage that understands your industry and can make the size of investment that makes sense for both of you and can add more than just their money.
That's great. I feel like we could close down the laptop after this, and our folks would walk away with that great advice. But I think to sum up what you're saying is, founders really you want to get out there and research and make sure it's a good alignment. I was meeting with I met with some founders earlier this week that are in the fundraising stage, and yes, the tendency is, especially when you're early stage, is just to take any money. Which obviously can be bad. But even as you get further down the road, if you've bootstrapped kind of deep into your journey, going for that first round, it's really more of I'll call it more matchmaking, right? I think is what you're saying
Right.
is, you
Right.
want to just make sure that they align. we talked a number of weeks ago about not losing your North Star when you go for investment. So
Mm-hmm.
if you want to get more on that, we had an expert on that. I guess it was a couple of weeks ago. So,
Mm-hmm.
well, Sarah, we'll move on to our second question, which is kind of walk us through typical mindset of a founder who's feeling some pressure for cash, whether that's board or whether that's operating, and what drives them kind of straight to VCs.
Right, right. I think there could be a mindset of, oh my gosh, we're running out of cash, and you know, we need money fast. So let's raise equity from VCs. That'll solve our problem. But really, sometimes there could be more to it, and there could be a bigger issue and a few things going on. And so, there could be a panic that there's a short runway. You have some urgent or pressing liabilities that you're facing, or it could be a focus that venture capital is just a default solution. It's just something that founders assume, that's a natural stage for natural next step for raising money. Or perhaps their stress can create a tunnel vision, and it could cause you to overlook less dilutive ways to bridge the gap. We can talk about some of these later, Dan. We'll talk about alternatives like perhaps revenue-based financing or other sources of debt. Maybe cutting costs, extending your payables, asking customers if it's possible, can they prepay? Or could you create partnerships that could be monetized? Or lastly, perhaps founders are hoping that the capital will fix a deeper problem when the issue really could be more fundamental, and more cash could just be hiding the business issues for a while, and that's not going to fix the problem. So, the risk in running straight to VCs is that, founders, you could have less negotiating leverage. They'll sense if you're
Right.
desperate, and your valuations could take a hit, could be more dilution, or you could accept, a poor fit investor, or terms you might regret, or miss more creative ways to solve the problem.
No, that's just all great advice there as you talk about kind of that mindset. And yeah, like you said, it may not have anything to do with funding. It may be something more fundamental in the organization. It may be that, their costs. We see a lot in our business, a lot of acquisition costs being really, or CAC being very, very high,
Yes.
because normally it's somebody that's pre first round because they spent so much in their first round, but they didn't think about what their burn was over time. And so, sometimes the easy thing is just, cutting back and re-establishing, or, looking at other creative alternatives like outsourcing or using fractional help. I also think,
Mhm.
to me, if you get on any type of social media, LinkedIn included, but probably worse on like an Instagram, is you see the VC funded companies are always the ones that are kind of front and center, right? And it's
Flashy.
right, it's the unicorns, right? It's the
Right.
person
Yeah.
that was the overnight success. Well, and in reality, they're a 10-year overnight success. But I think that yeah, there's a lot. I think there's a lot of misinformation. I don't
Mhm.
think either one of us are saying the VCs are bad. We're just saying
No.
there may be less dilutive options that are out there.
100%. 100%.
Yeah. So you specialized in healthcare banking. How do revenue-based financing options work specifically? Let's say, I'm going to say broadly in the healthcare space.
Sure. Sure. So while I will caveat that my experience has been mostly as a traditional lender, so I've never been that girl that provides the revenue-based financing, I can tell you how it works. And that
Mhm.
is that a lender will provide capital upfront in exchange for a percentage of the business's future revenues until a certain fixed repayment cap is reached. So let's just say a business generates 100,000 per month in revenues, and the lender sets a repayment term of 5%. Then you're going to pay 5,000 per month off your revenues until the capital advance has been repaid. And most lenders are looking to get repaid within a period of between 6 to 18 months. And so, naturally, an advantage is you're not giving up equity. So that's
Right.
great. And you're not dealing with a, sort of rigid payment schedule or any potential guarantees or other terms that a bank could require. And the repayment can be working alongside your revenue collections. So I think it can work well for certain types of healthcare companies. Especially, I think it's perhaps a little less common for healthcare service providers than it is
Right.
and more common for SaaS or e-commerce. Not that it can't
Right.
work for providers, but when there's a consistent monthly cash flow and there's a need for that growth capital and you want to avoid giving up equity or guarantees, I think it's a great option. Some of the challenges can be, if you're a service provider, you're dealing with insurance reimbursement. And, we all know it can take a while sometimes for insurers to pay, for various reasons. And so that lumpiness can give a little heartburn to some revenue-based financiers. So, and you have to be careful too of regulatory or compliance issues in terms of
Right.
being, making sure you're able to pledge your receivables. And so I think you
Right.
have to be mindful of the cost of capital for revenue-based financing. It can be expensive, but I think it can work in certain situations, and certainly it's cheaper than raising equity.
Yeah, no, it's a great point, and I think one of the things, and I'm sure we'll talk some more about that later in our article this week. Those of you that read that will notice that there's some things that you have to do to get in place, and one of them, we always have the conversation with our customers is the ultimate goal is, consistent revenue, right? And I think getting to that point where you've got that consistent revenue that you can iron out. Now, there are some businesses that you don't ever get there, right? If you're selling, uh, you know, $500,000 platform, um, you're in, that's the only business you do. You're going to go like this. I mean, there's going to be, but if it's, if you're in the SaaS space and you're, in this, I'll say the sub 100,000
Mhm.
type solutions, getting that consistent revenue definitely helps you get to the point where you get options. And a lot of that has to do with, pipeline management, all the things that we do with our companies. But yeah, that's a great point and great help, I'm sure, to folks. What's the difference between asset-backed
Mhm.
lending and traditional bank loans for,
Sure.
I'll
Now,
just say software companies?
that's a great question, Dan, and I could see how it could get a little confusing because a lot of traditional banks will provide asset-based lending, but then there are
Right,
also specialty lenders that's all they do. So
right,
in both scenarios, whether it's coming from a bank or a specialty lender, the just big picture, the concept is you're borrowing against specific assets. I would say, I think in this situation, we're usually talking about accounts receivable. Although, if applicable, you can borrow against inventory or other tangible assets, and the lender will do diligence, will kick some tires, and then determine which assets they can lend against and what is that percentage. And I would say, in my experience, it can be between maybe as low as 70% or up to 90% of eligible accounts receivable. And then as cash comes in to your account, it is applied to reduce your line. And in order to reborrow on the line, you evidence that you've got new receivables. And, as is typical, from a lender perspective, the lender can seize those assets if there's in a default situation. So it's nice because it can be flexible to borrow up and down. Um, and although there's going to be an upper limit. The lender will say, we're not going to lend you over $1 million. You could even have eligible assets over $1 million, but they can't go beyond that upper limit. Maybe that's something you could revisit um, over time. But and the costs will vary depending on the nature of the business, but there'll be an interest spread plus a fee for managing the collateral. And, it works really well with companies with a good amount of accounts receivable and strong collection rates or, with other assets. So, a lot of SaaS or software business don't have the other hard assets. And, sometimes, there might not be a lot of receivables if folks are paying upfront. But, so if you have the situation where you have, larger contracts and you have invoices that can be pledged, it can make a lot of sense. And so now we can talk a little bit about, if you like, Dan, I could also talk about traditional bank lending.
sure.
Yeah, and so that's where a bank will lend a company, borrow money based on the overall credit worthiness of the company, looking at the business's profitability and cash flow, kind of looking, they'd like to see consistency. But I think they're open to hearing your story, if there's some noise, if you will, which is quite often more the case than not. And banks will also take into consideration collateral and personal guarantees. And, the types of structures, right, are revolving lines of credit for working capital, or that can be term loans available. So I would say, traditionally banks are going to look at cash flow and recurring revenue for SaaS companies if there aren't a lot of hard assets. So, you are going to have a fixed repayment schedule, could be monthly or quarterly, interest payments at a minimum. So if there's a term loan, you could have principal payments as well. And for traditional bank lending, while it can be harder to get, it's usually the lesser expensive option if you can qualify for it. And there will be covenants. There will be, you'll have to maintain certain, minimum cash flow, profitability, customer retention, whatever terms could make sense for the business. And then sometimes a bank could require personal guarantees depending on the business as well.
Yeah. 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 Well, and I think as I'm listening to you, I'm thinking, certainly the best way to build your business and not give up any equity is not have to borrow any money, but that's really not feasible a lot of the times, right? Or you have
And
to
sometimes,
be,
you don't want to
you know,
forego growth, right? And, the
right.
debt could be a good
And
cost of
that's
capital.
right, right. And I think that's the thing. If you've got
Mhm.
a long runway, if you're in your early 20s, you're building a business for the next 40 years, yeah, maybe you can do that. But I think just trying to figure out what the right instrument is for what your goals are is really important. I feel
Mhm.
like the line of credit gets that gets forgotten a lot, and I
Oh,
think that's not something that people leverage because most of the time, at least in my experience, a lot of the companies that I talk to that are looking for a round,
mhm,
it's not necessarily to fund something specific.
mhm.
It's around helping smooth out cash flow, which obviously the line of credit is a great thing to use there.
Absolutely, Dan. I agree with you. Yeah, so I think it's always good to get to know your bankers and start developing
Yeah,
those relationships early, and exploring those options.
yeah,
Maybe
yeah.
even sooner than people realize.
Yeah, I feel like on this, as on like even on your marketing, people tend to want to do it at the point they want a result rather than to invest, whether it's time or even money into something,
Yes.
you know, prior to that. So, like you said, having those relationships, we always say in the marketing, hey, you got to invest before you want to sell, you've got to invest some time and effort into marketing, right? And unless you can just find a unicorn that can create opportunities for you, that's very rare. But yes, I think that's great advice around having those relationships. So
One
you
thing, if
mentioned
I
a little
may
bit.
add, Dan,
Yes,
I would
yes,
say
please
that
do.
in banking, we always say the best time to ask for a loan is when you don't need it.
Right, right,
Asking for a
right,
loan when you need it, it can be harder. But when things are good and you
right.
feel like you don't need it, that's the best time to go establish
Yes,
that line of credit. And the banks would makes them feel good, right? You've got this line, and oh, your business is
right,
performing so well, you don't even need it. But then something comes up, they'll be happy to
right,
see that you're actually using this credit facility
right,
you provide. But
right.
when you don't need it, I think it's the best time to ask for
Yeah.
it.
No, that's great. That's great advice. You talked a little bit about specialty healthcare
Mhm,
lenders. Can you just maybe give us a quick overview? And I think you talked about it a little bit earlier, but I think
mhm.
if you could maybe just revisit that kind of, we don't have to use
Sure,
names, but kind of what
sure.
is what are some
Yeah.
examples of how they do what they do?
Sure. Absolutely. So I would say in my world, what I know is, there are specialty lenders that focus on healthcare. I know there are a lot of other specialty lenders out there. They serve a different role in the financial ecosystem. What I would say as a traditional lender, I had a lot of relationships with specialty lenders, and it was a beautiful relationship. And you're like, oh, because we weren't competing for the same customers. They were like, Sarah, if you and your bank can't provide a credit facility to a company, think of me and give me a call, because that's where they can step in. So, so a lot of times, that can be the case, right? Where they can do some things. I don't say it's maybe a little earlier stage, or a little hairier story, and not quite ready for a traditional bank. That's where specialty lenders are a great option. And they a lot that I'm familiar with, they have are very focused on a certain industry, and so they understand the nuances. Reimbursement cycles, regulatory changes, et cetera, as it pertains to healthcare. And they can have a little bit more flexible underwriting, and maybe a quicker turnaround than a traditional bank. So those are some things that I think I would highlight, Dan.
Okay. Yeah, sure. So, family, at least in my experience,
Mhm,
and again, I will caveat what I say, it is just my experience, but
mhm,
I have seen family offices being much more active now in
mhm,
healthcare.
mhm,
And we don't necessarily have to get into details of how they structure, but maybe let's talk a little bit about kind of what their goals are. And let me kind of give a prompt a little bit to this, because I think I've had several family offices reach out and say, "Hey, do you know
mhm,
of any companies?" Now, that does not mean I go and find funding for folks. That is not what I do, and I'm not an expert at that. But it seems to me, and maybe you can say yes or no on this. It seems to me that of the financing out there, I would say your VC is probably your most aggressive on taking equity, and the most aggressive on results.
mhm.
Private equity is kind of in the middle, and then family office has a much longer runway, and they're looking to invest for more long-term growth. Is that a fair read of the market, or would you differ with that?
I agree with you 100% that family offices are going to have the longest term horizon in
Right,
terms
right,
of investing. And they could have, you know they'll customize deals that could match their goals. Perhaps they have a
right,
certain initiative that they're
right,
focusing on in the healthcare space, for instance, or they're looking to build a legacy, and they'll partner closely with management, for tailored strategies, and kind of take a more patient and nurturing approach, and
right,
guidance and capital without the pressure, because they
right.
can have a longer horizon and
Yeah,
more patient
yeah,
capital.
yeah. No, that's great points, and maybe I should also say I think people are familiar with what venture capital or VCs are, what PE
Hmm.
and private equity.
Hmm.
Let me explain a little bit. So, a family office is typically somebody that has, or a family that has exited a business, and now they're looking for a place to put their capital to work. And they typically lag the market. So if a lot of the VCs are getting active in healthcare and then PEs are getting active, family offices typically follow because they're going to go where that money is, and of course where they can get better returns on their money. Um, and there are ones that are very, very, very skilled, right? That have been doing it a long time, and there's some that aren't as skilled.
Hmm.
I think the one thing I would caution is they're normally very smart about the money, but they may not be experts in your industry. And I think that would be the difference between like PE or VC, who are normally at least have some cursory knowledge of the industry and can maybe give a little more guidance. For family offices, it's sometimes it's just two or three people that are active, but it's a large amount of assets. I know during COVID, I must have talked to 20 different family offices that had capital on the sidelines that they were looking to deploy
Hmm.
because, the events and things that they went to were no longer there. So,
Yeah.
yeah. So, anyway, I thought I would explain because maybe people are like, what is a family office? I wanted to do that.
Yeah.
At least go down that path a little bit. So what financial metrics do alternative lenders focus on? And I think I'm gonna pause there because I think
Hmm.
most people know what VCs look for, but what
Hmm.
kind of financial metrics do alternative lenders look for?
Sure. Alternative lenders, they have a different focus, right? It's, any lender, success is getting their loan repaid, principal and interest as agreed, right? They don't have upside. So it's really kind of a downside protection and risk mitigation. And, so to do that, I think there can usually be certain metrics, they want to put in terms to their agreements to catch a business before things, slip too far, right? So can be like a minimum debt service coverage, can be things like a maximum leverage, whether that's senior debt or total debt you know, to companies trailing 12-month or TTM EBITDA. And a lot of times, I think you should always look at it where applicable adjustments to EBITDA. Perhaps, there are one-time expenses that happen, which again, it happens all the time. And so if you just point out to a lender, oh, we incurred, $1 million last year in legal expenses, it's non-recurring. Like, okay, a lender will be like, I can add that back, and I'll look at that your EBITDA on an adjusted basis. Or maybe you made an acquisition in the middle of last year. Well, and you took on some debt for that. I'll give you the full year credit as if you own that business for a year when I'm looking at these
Right.
ratios.
Right.
And for especially lenders, often the collateral is important. So loan to value is going to be something that they're looking at as well. But yeah, so those are some of the key metrics that especially lenders kind of not dissimilar to more traditional lenders I think would be looking at.
Yeah, and I think that's a really good point where where their focus is, right? So an alternative lender is really focusing on getting the money back that they loaned, right? I mean, what
Right.
that and getting some interest on it.
Hmm.
Whereas a VC most of the time is making the investment to flip it within, a fairly short time
Hmm.
period. So they're going to be looking more for um,
High growth.
not necessarily signs for the health of the business, which I think
Hmm.
is what a lender looks like.
Hmm.
It's going to be more looking at, okay, what can we show to show growth, right? So there's a lot of top line focus there, which at the end of the day really doesn't matter as much to an alternative lender because to them, like you said, it's around EBITDA. So
Hmm.
or available cash, right?
Right. Right.
So this one is one that I kind of focus in on. Like I said, we do an article on Fridays. So come back to LinkedIn here tomorrow, and you'll see an article. But I've seen founders with messy operations get worse terms. And when I say messy operations, I want to be specific. Basically, very little discipline around things like a CRM, leads, pipeline performance, uh, understanding their customers. So how much does having things like that impact, funding? I'll say it like I said it here. How much does operational readiness impact funding options?
So, Dan, it's a great question, and the answer is it absolutely has an impact. I would say that a lender is probably going to have a little bit different of a focus in terms of understand. I don't know. It would be a very I haven't seen it a lot. Like I don't know if I've ever really asked about a customer's CRM or
Right,
I think the lender is going to, but I think it's probably a reflection, right, of the discipline and the controls in place. Because I think lenders going to look first and foremost to financials, right, and how confident
right,
are
right.
they in being able to rely on the numbers that are provided and the systems, and the timeliness of reporting for financial. So I think
Yeah,
that all
yeah, and
goes into the mix.
I think I'm thinking more about, and I went probably two levels too deep, but forecasting, right? Being able
Oh,
to forecast
yes.
and being able to understand your revenue and cash flow. Because to me, I'm surprised that, I talk with businesses that are, 3, 4, $5 million in annual, recurring revenue, even
Hmm.
higher,
Hmm.
that have really no visibility to what's making them money,
Hmm.
what is the forecast out there. And when you're just running it yourself, you can limp by like that. But
Sure.
I think when you
Yeah.
bring a third party in, by the way, whether that's a traditional
Hmm.
lending or VC or private equity, being able to show that progress and show kind of where your money's coming from and I think that's probably I did a bad job of phrasing because
Okay.
the question, but I think it's more about I think to me it's more around forecasting both cash flows and revenue and all of that kind of contributing to it.
Absolutely. No, and I appreciate you elaborating on that, Dan, because I think you're absolutely right. I think I kind of, again, coming back to having confidence, if you're going to raise capital from an outside investor, whether it's debt capital or, equity capital, I think, people are going to need to feel confidence that you're going to be good stewards of that money
Right.
and need to understand how that money is going to be spent, right? Um, and and I would say it's the correlation, right, of risk return. I think when you have sloppier operations, people are going to perceive that risk is higher, and you're going to
Hmm.
pay more. You have to pay more for the capital, and it could take
Yeah.
longer to raise the capital.
Well,
Whereas the
like,
alternative, the opposite applies, right?
yeah, no, that's a great point because I think kind of getting your house in order before you do that, and it's we've done that with some companies that are even getting ready to sell. I always this is very, very simple, but I think it applies. I always tell people when you're getting to the point where you're going to sell or you're going to go for a significant, round, um, you have a money making machine, right?
Right.
And you need to portray confidence to whoever whoever's going to be lending you the money, or if you're going to sell, that money making machine is going to operate and it's process driven and it's not just a roll of the dice every month. So we were talking about Vegas and leading up to here.
Yeah.
So I think I'm onto the gambling, but
Yeah.
but I think just having that having that process in place is in the visibility of that is super important. By the way, it's true if you even have private investors or angel investors. I mean,
Oh,
you've got
sure.
to be able to show them, what you're doing. So,
Yep.
I think we talk about this a little bit more.
Mhm.
Like, well, we kind of went through this, your
Mhm.
capital readiness checklist
Mhm.
that founders should complete. Would there be anything else that you would add to what we just talked about?
Sure. Oh boy, yes. I would say, again, financials are going to be the starting point, right? Making sure you are able to provide your historical financials, kind of your most recent financials, and provide a plan for, whether eh, it depends on what you're asking for, right? If I had a customer or a client asking for a 5-year loan, I'm like, well, show me over the course of 5 years how you're going to repay that loan. That seemed fair, right? But not every loan request is going to be for 5 years, right? And not every plan will need to be that. But kind of keeping in mind that the plan is incorporating how you're going to use the funds and how the if it's a loan, how it will be repaid. um, and then I would say it's also kind of having at the ready all of your key performance indicators, an understanding. I think we were chatting earlier, Dan, of your business lines and the profitability associated with each of those business lines. Who are your key customers? Are there contracts that you have? What's your customer retention? Having a lot of those key performance indicators at the ready. Um, and then, last but not least, is your kind of corporate and other business documents, whether just your articles of incorporation, any other key agreements. Are there key employee agreements? Do you have NDAs? Do you have intellectual property? Just a lot of those key business agreements to have those on hand as well. And once when you're armed with that, I think that you're a founder is going to be best positioned to put themselves in the best light in terms of evaluating bringing on potential capital providers.
That's all really, really great advice. And I think we literally just covered this on the last thing that you mentioned about compliance documentation. I think I think we covered it. Would there be anything that you might want to add that we didn't cover in that last question?
Oh, just always important to have the right counsel along
Right.
these lines.
That's a really yeah, that's a really good point because I think sometimes having an expert that like you that knows what they're doing in this space and that can help connect them or just give them advice. Obviously it's not something that we do.
Mhm.
And it's always great to have people that we can send to you, Sarah, because you know this area. But yeah, just having somebody that's been there and done that and knows what your options are is
Absolutely.
absolutely
Yeah.
great.
Yeah. Somebody with
And I know we
experience in your
yeah
specific business, because a lot of times these can be regulated businesses and there can be a lot of nuances.
yeah
So it's important to have that right, that right partner when it comes to
yeah
comply. It's critical, as you know.
yeah. No, I think you're exactly right. So, we talked a little bit about this kind of in the lead up, but what would you say to a founder who's concerned about interest rates for kind of, let's
Mhm.
say, traditional, either alternative financing that have remained stubbornly high?
Yes. Yes, yes, they have, Dan. And at least what I would say is that the most recent projections that the Fed has put out from June, they are forecasting 2 25 basis point cuts before the end of 2025. So have some hope that
Right.
it could be coming. Um, but, and I think, one key metric that I think a lot of people follow is consumer confidence, right? And the University of Michigan puts out their kind of monthly consumer confidence, and we hit a high in December 24. People were feeling really good, and then things, after Liberation Day, a little, things came down quite a bit, but we've come back a little. So consumer confidence is improving, and I think you're also seeing some data points in terms of, people are looking to spend more on air travel. They've started to spend more this summer. So
Yeah.
those are good data points in terms of consumer confidence, because as you know, the consumer drives our U.S. economy.
Right.
Um, so I think there is hope that interest rates could come down this year. I think that's, again, the Fed is expecting they'll be able to drop rates twice. And they'll be very data dependent. I think, all eyes are going to be on what happens with tariffs, right? We're all watching
Yeah.
this, and,
Yeah.
I think striking these deals, like this is good. But so for founders who might be looking to bring on debt and, I, I would say just to have a prudent approach in terms of, you know, making sure to kind of protect against any sort of unexpected rate increases, but maybe giving yourselves optionality to ride interest rates down.
Yeah, I think that's a good point. I think also as we think about this, it's still to me better to look, if you can, look at debt versus giving up equity. Even
Sure.
though, I mean, and I wouldn't say that they're historically high interest rates if you go back,
Right.
if you take a 30 or 40-year view of it, or
Right.
even a 50-year view, because I mean, in the late 70s and early 80s, mortgage rates were at 17 and 18%. So,
Yes.
yeah, but no,
Yes.
all good, advice. So, what's the typical timeline? I'll just say for closing a
Mhm.
revenue-based financing round versus a traditional VC round.
Right. I think I think it's a great question, and I think intuitively, as people would expect, um, yeah, a VC round generally is going to take longer than a revenue-based financing round. And again, it all comes back to how ready are you, right? If you are approaching either type of investor and you have all your ducks in a row, as we've discussed, then you should expect, things will move faster. And so I think on average, a revenue-based financing should be able to close within 4 to 8 weeks. Maybe it could be sooner, but I think it's, that seems to be a reasonable range. And if you don't have all your information ready, it could take a little bit longer. Venture capital, in my experience, especially if you're looking to bring on a new investor, it's going to take a little while. It will, putting aside the time to prepare all the information you're going to need to be armed with to go out and speak to potential investors, that process can take a month or two, and then you'll get a term sheet, you'll negotiate the term sheet, close. That's another month at least. So, the revenue-based financing is, you should expect that to be, a fair amount quicker in
Yeah.
general relative to
Yeah.
a VC round.
Yeah. Good. Well, let's move on to our next question. So, how do you evaluate whether, I'll just say whether your company, since we're talking with founders, is better suited for debt versus equity financing?
Sure. So I would say, starting with, the concept and the notion that, debt capital is always going to be cheaper if you can get it, right? And so, if you're better, are you suited for debt capital? I guess is the first question. And that I would say, do you have predictable, kind of steady revenues? Do you have positive or near-term positive cash flow? And is that enough to cover principal and interest? And what are the uses of funds also, I think, is something you have to take into consideration. Is it really to smooth out working capital, or maybe for some short-term growth, or to refinance more existing debt? Then those are situations that I think line up very well for debt capital. And equity can make sense if your cash flow is not as consistent, or maybe you're negative cash flow, or even pre-revenue and you're burning cash. Your growth strategy requires more patient capital versus a rigid loan repayment. And one other thing I would say is, what does the balance sheet health? What does
Right.
the right is what existing debt, if any, may there already be, and do you have capacity to add any more? Because if you don't, then sometimes maybe you have to, equity is your only realistic option.
All great points there. Yeah, I think it's sometimes it's just a quandary for folks to, which direction do I get started in? So that was really
I'm a
good
little biased,
advice.
but
Yeah.
I feel like maybe you always want to start with seeing if you can raise debt first.
Right.
It depends on the
No,
situation.
I
I
don't,
think you got to be realistic. If you're
yeah,
negative cash
yeah,
flow, yeah, or you don't really have the assets. I think if you're realistic, but if you're on the cusp, I would always consider or explore debt because
yeah.
it's cheaper
Yeah,
and more
I
control.
think that's really the point that I would like to make, overall is explore your other options because giving up equity isn't always your only option. I
Right.
think, with most of the companies that we work with, they're beyond that negative cash flow. They've been around for at least a period of time. They're post MVP. They're
Mhm.
starting, to scale.
Mhm.
And again, as you think about scaling companies, if it is, something where you've got to add a development team, right?
Mhm.
Something like equity may make sense, but if it's just simply trying to smooth your cash flow, that to me is I can understand sometimes founders feel desperate, but that's sometimes a really bad way. Equity is a bad way to go try to smooth cash flow because typically that's a cyclical problem
Right.
that can address.
Right. That
So,
a
so
working capital line can be a great solution.
yes, no, you're
Hmm.
exactly right.
Hmm.
So, and again, this is something I think we covered earlier about red flags that might disqualify. Do you want to expand on that at all?
Sure. Yeah, so I would say that I agree. I think we covered a lot. It's kind of when we talked about making sure your financial house is in order, right? Um, so, as a lender, I would say I remember had an experience where we were talking to a company. We really liked the type of company it was. We liked the management of the company. But when we started digging in to the financials and asking questions, a lot of times we get information and there were inconsistencies in the number. And that just, once that happened, all of a sudden it was dead on arrival, right? When the numbers didn't tie. So to me, it's, that's one thing that I think can be a quick disqualification. If there is overhang with potential litigation or just some uncertainty, then maybe it could be a difficult time to enter into a lending relationship until some things get sorted out.
Yep.
Or if during diligence, if compliance issues come up, then a lot of times
Right.
that's that's going to be difficult to try to close on something until those issues get addressed.
No, makes perfect sense. So we actually talked a little bit about this.
Mhm.
So I do talk with a number of companies coming from Europe to the
Mhm.
US, and I think that many times the thought is getting funding in the US is easier than in, let's say, Europe,
Mhm.
or their home country or countries. Um, is that I, I know the answer to this because we've talked about it,
Mhm.
but is that a correct assumption or is that incorrect?
Well, I would say it might be easier once a company reaches a certain stage. I would
Yeah,
say initially, a company coming over to the US from Europe, even it could have a beautiful business, a very, very lendable business in Europe. But as you're starting in the US with a bank, it gets challenging when it comes to things like KYC. I've just had this experience where it makes credit people very nervous. I would say until you reach a stage that the US business could stand on its own. And you could try to say we can just seal it off, right? Okay, the company, has reached a point where they're profitable, they've established themselves. And we could, because then I think a lender can kind of wall off and just say, okay, we can just look at that U.S. Entity and it stands on its own. Because otherwise, things just in this environment of anti-money laundering and KYC, it just I think it gets difficult for banks, for lenders,
yeah. No, I think
as the company's just getting started in the U.S.
yeah. Yeah, so I think the answer is they need to be mature and they really have to have a separate profit and loss and really a separate entity in the US to
Yes.
leverage that for lending.
Yep.
Just for those of you, I think our US based folks know what KYC, but that's a know your customer. And you mentioned AML, which is anti-money laundering. Both of
Right.
those make it difficult many times for foreign entities because you're not collecting that information anyway. In the
Right.
US, you're typically collecting that from day one. So,
Right.
every regulatory environment is different.
Right.
Um, so again, I think we covered this earlier, and I know we're
Mhm.
starting to get short on time. I think you did a great job of kind of giving an overview of what's going on around interest rates.
Thank you.
Anything else you might want to mention about the current economic environment changing alternative lending?
Sure. What I would say is that perhaps the fact that traditional banks might be tightening their lending standards a little bit in this environment,
Yep.
I think that creates opportunities for alternative lenders, and I think they kind of step into the void. And I think everything, from what I'm hearing, all sorts of data points that there is capital available for businesses, for the right purposes. And frankly, there's probably been a little bit of a dearth of opportunities because a lot of people are taking a wait and see approach. And so that might almost be beneficial for the founders who kind of have a conviction these days and are looking to raise capital because I think what was it in the bank earnings cycle? A lot of there was banks were saying a lot of people are just saying you can't wait forever. At a certain point, we
Right.
have to just live with,
Right.
there's a certain level of uncertainty that we're probably going to have to live with
Yeah.
in this
Yeah.
administration, and you can't put your life on hold forever.
Right. Right.
And so as people, come around and, like I said, have the conviction, I think that they'll find that there's a lot of dry capital or dry powder that people are looking to put to work. And again, if banks have tightened their standards, which I'm not so sure. I don't know. I'm hearing that there's a lot of competition for what few deals there are out there. But always, I think
Yeah.
as
It's
banks pull back, I think that always creates opportunities for alternative lenders, and there's
And I
plenty of
think
capital.
it also depends on the industry. I mean, again,
Yes,
we both know that in
yes,
healthcare and health tech, there's a lot of money right now, more so than say maybe fintech or payment tech or some of those. So I think that also has and people know that the one thing that's for sure is the spending on healthcare, at least in the U.S. market, is not going to go down over the next 25 or 30 years. So I think that's why
right,
there's money there.
right. And there were with the big beautiful bill passage recently. I
Right.
think we're all aware there were substantial Medicaid cuts that were announced. So I think that's something that for people in the healthcare space, I think everybody's going to be very mindful of how that flows through. And you know we'll see. I think we'll see how things play out. But I do think that is something that people will have to be very mindful of, I guess, where applicable.
Yeah, and I think just on that subject, the one thing I think that's interesting is that does create a lot of opportunity for companies that can help impact reimbursement.
100%.
Yeah.
Challenges will
So,
always create opportunities, and I think for those that can step
yeah,
up and be part of the solution. I agree with you.
yeah. So, I think on this one, I'm just going to do a quick flyover, but I
Mhm.
really think on this one is that you have alternatives, and that just because you've started a conversation doesn't mean you need to finish the conversation. I mean, there's other things that you can look at.
It's exactly what I was going to say, Dan.
Yeah, good,
Just
good.
because you
Well,
started the
hey,
conversation doesn't mean you could
right,
tap the brakes.
right.
You don't
Yes,
have to
yes,
you slam on the brakes. You could tap the
right.
brakes and maybe take that intentional pause and step back and talk to a trusted advisor or reflect. Are there other options? But yeah,
Yeah.
we're on the same page.
So I'm going to skip here to the end because we've got two questions at the end that I feel like are very practical, and that's what we really want to do is leave our listeners with some very, very practical advice. So, what questions should founders ask alternative lenders to ensure they're getting the fair or the best terms?
Sure. Now, it's a great question. And I would step back and start with a couple things. It's always put yourself in a position of strength. And,
Right?
don't try not to have your eggs in one basket whenever possible and know your market. So to me, it starts with when you are, going through the process. Again, not all your eggs in one basket. You might seek, run parallel paths and talk to a couple different providers. In my experience, I feel like that was the case more often than not. Maybe to somebody's chagrin, but and so what that can do for a founder is they'll understand more what are their options, right? And maybe you collect a couple different term sheets from possible capital providers and try to compare them side by side and decide what terms what are the most favorable terms. And in your gut you probably know who you want to work with, who is your best partner. And so I would go to who you think that best partner is, who lines up, understands your business, somebody you think that you can work with now and for the foreseeable future. And ask the question, if there's certain terms like, oh, is there any way that you could work with me to lower the rate? Maybe if I hit certain metrics, could you have a pricing grid that my pricing could come down if if my business improves, if my leverage comes down, or whatever metric that makes sense. So I think having that position of strength is always beneficial. And maybe you even decide to go with a provider that isn't the cheapest cost of capital, but again, just your gut is, this is somebody I want to work with. They know my business. It's just a partnership that makes sense. You could let them know I chose you even though you weren't the cheapest, but hopefully, this is something that's important to me, and could we try to revisit, that term, as if I do what I tell you I'm going to do, could we revisit, that pricing or these covenants or these restrictions kind of a year down the line? And I think that could go a long way.
That's great advice. So if you had, and it doesn't have to be three, but I would just say if you have advice to founders considering their capital options, what would those be if we were to sum it up in just a couple things for them to take away?
Yeah, maybe like you said, three things. Going back to where we started, right, is just being very mindful of the investor you decide to work with, and make sure I would look for the smart money, and try to raise capital at the lowest cost possible, but being mindful to not over lever a business, because that's where you can get into problems and you can limit your options. So those are my things. Look for the smart money, raise as much low cost capital, but not going too far to over leverage and put yourself in a position where you don't have any flexibility if something comes up.
Excellent. Well, great. Well, that's a great place for us to end up today. So thank you so much for your time and spending it with us. I will mention that next week we're actually going to be kind of on a topic that's a little bit different. I do not have a guest next week, so you're stuck with me. But we're going to talk about, seriously, don't scale your SaaS on spreadsheet glue. So you'll have to tune in to figure out what that means. We'll be dropping our song on Sunday, as always. And as I was telling Sarah, you're going to look for something that's a lot more high energy this week with the song. So go check that out. If you want to get in contact with us, this is the best way to reach us. So you can see there my LinkedIn, Sarah's LinkedIn, and certainly would love to talk with you there. And then if you'd like to book me for a speaking engagement or a podcast, reach out to Jan at Grow with Dan. So I want to thank everybody for attending today. Wish you a great rest of your Thursday, and we'll look forward to seeing you again next week. Thanks.
Thank you.
Got a call from a founder last Tuesday night. Pipeline's empty, board meetings Friday. Should I raise around?